What question is like the main question that you get from investors all the time?
On average, how much are you spending pre-investor, would you say, per project?
How do you decide which dollars go to which project?
But anyway, I bought the land. It took me over 2 years to get all the entitlements done, and I had already purchased the land.
Is the bank financing a portion of the job cost as well, or is it just the land purchase price?
I was 99% sure.
I get the toilet paper, buy in bulk, the whole Costco philosophy.
And have you ever chosen to not deploy capital?
Building massive businesses, we've been obviously in this country, largest transfers of wealth and baby boomers just coming of age. And when you buy a business, you have
All right, welcome back to the show, everyone. Today's episode is powerful. One, because we're pulling back the curtain on something that's very important to me, but in what every growing company has to pretty much master, especially people that are in my industry, is how to raise capital from investors the right way. Here at BluOnx, raising money isn't just about funding projects. It's about building long-term relationships for us. But today, I have two of my colleagues that are joining us. I have Daniel Patrick with us, who brings a wealth of experience in strategy and investor relations. He's been doing this for quite a while. And then I have Andrew Clements, same for him, works closely with our operations and development side. So guys, welcome.
Thanks for having us.
Get the conversation going.
Yeah, no, I'm looking forward to it, honestly. It's a great topic for conversation. I know you guys get hit with this stuff all the time since you're working with a lot of the investors. So Daniel, what question is like the main question that you get from investors all the time?
That's an easy one. I mean, there's a lot of questions, but as far as like the money management is concerned, it's really just like, where is my money going? What are you guys doing with it once I make my allocation? And how are you using it to turn a profit? Which I know that's a couple different questions, but mostly people just want to know, like, where is it going? From an investor standpoint, it goes into this imaginary ether, which obviously is not the case. Like, we're actually using it, but you're the man steering the ship. So where does it go?
Well, let's start a little bit of pre-investor then to, kind of give a little bit of context so the investors understand how I set up our deals. So when I say pre-investor, that is the entitlement process. So once I put a piece of land under contract, and I think you guys know this, so you can jump in and throw in anything you guys have on this, but pre-investor, we're doing entitlements. All that risk is on me as the owner of BluOnx. So when we're going through the entitlement process, there are situations we find out that a development just might not work, and I might lose 5, 10, 15. I've lost up to $80,000 on one deal, which that deal might actually be revived. We had a great meeting. I'll jump into that a little bit later, but a great meeting with the city. Again, we're just switching to products, so we'll see where that goes. But usually I only lose about $15,000 on that side if I do lose a project. Now, usually before we start a project, we go meet with city council. There's really no money out of pocket. We might have spent like $2,000 to draw up some kind of site plan, something to say, hey, this is what we want to build. We're going to build 25 single-family homes on the one we're pitching yesterday over in Darty and Prairie. We're going to build 25 single-family homes. Do you guys love this? Here's what our drawings look like. And, we grab stuff from Fisher or whoever that's going to be building the homes, or we'll have something roughed up. We presented them. They say, hey, we love that. We'd love the idea of that being there. Go ahead and present it to city council or the board of aldermen and get it going. So we know relatively quick whether they like it, love it, hate it, and whether we're going to kill that deal or not. At that point, I'm spending a bunch of money at that point. So I've already got it under contract, usually an option contract for somewhere between 6 months to 12, maybe 24 months. It depends on where I'm doing the development at and how much time you need. If it's Wildwood, Missouri, where I live, they take forever. So a lot of times, you're at 18, 24 months at least. So in that process, though, we're doing a lot of geo work, site testing, surveys, trying to get all that detailed information. I engaged our engineers, which that's where you spend the vast majority of your money. So this is all pre-investor. At this point, investors are not in it all. I'm trying to make sure the deal works. I have it entitled. Let's say we're at the entitlement phase. We're done with entitlements. We're approved. At that point, that's where we start bringing investors in. Do you guys got anything you want to add on that part that you have questions about before the investor comes in?
No. And I think that's a big one. And I usually give them that information before they even ask. Most people don't think to ask when their money is deployed. We talk about entitlements and stuff like that. A question that I do get is just like, what's your skin in the game? And you just answered it. And we basically, before we deploy 1 red cent of investor money, we've already gotten a formal approval from the city. Like, they've already voted in favor of this development, like per the drawings. You've already paid the engineers. You've already done the soil testing, the topographic, the geo, all of that stuff. I mean, how much, by the time a property is fully entitled, I mean, on average, how much are you spending pre-investor, would you say, per project?
If it's going through the whole entitlement process, you're probably on average, depends on the project, obviously. So it's really hard to say average, but you're well over 6 figures. So, I'd say that 150 to 250 is probably average.
Yeah. There you go.
And that's money we spent out of pocket. We paid for all the entitlement process, engineers, any architectural work that need to be done if that is in place, the geo work, water testing, bat studies. There's a million things that have to be done, surveys. So all that's paid out of our own pocket.
Yeah. So you can't really be a small fry and do that kind of work and put up that kind of money to do that. I mean,
No, exactly. I mean, you can probably do one project, but currently we have 15 projects that are, part of our fund that we're, raising for, but we have probably equally amount of projects that we're working on getting under contract or going through the entitlement process. So there's a lot to that. So there's a lot of money that we have out of pocket, and that's something we got to really explain to sellers. Like, I can't tell you how many times, like, well, you guys are, just procrastinating. No, we're spending tons of money right now on trying to get this approved. We don't make a dime until we close on the land. So, and that's where the investors come in. So the question on the land part, or where their money goes. The first thing we do is close on the land. So, for example, the Overlook, we just closed on that a week and a half ago. That was altogether $6.2 million closing. So on that financing, depends on who I get it financed. That's where the investor's money goes initially. So I'm not raising 2 days, 5 days, 10 days ahead of just closing on that piece of land. I'm raising probably for 6 months, give or take, because I got other projects that are in the works. It's not just that one project. You'll have, like I said, 15 projects that we might be raising for that we know when they're closing. So if we're closing on $6.2 million, I know I need $3.1 million from investor money on the land purchase, which we don't have to. We can buy it ourselves, but I put $3.1 million from investors. And then as we go horizontal, we're going to need an additional, I forgot what it was. It's something minuscule, but they're approximately $1 million. And that will take care of all of our cost on that exact project.
Yeah. So if you don't mind me jumping in here, how do you decide which dollars go to which projects, right? Is it deal specific or portfolio wide? Like, how does that kind of work out?
Are you talking about when the investor comes in and they put their money in? I'm saying, hey, this is Andrew Clement. He invested $500,000. Do I depict where that money goes based off of his name?
Correct. Or yeah, sure. Or even just like, funds come in over the course of, the next 2 weeks. Like, how is it earmarked? Which potential projects those are going to? Is it on the, portfolio? Like, how do you prioritize basically where those funds are going?
So, yep. And I didn't do this right off the bat, which was super important. I organized everything by bank accounts now. So each project, I know exactly what's needed to make that deal happen. I know when that money's going to be needed, how much money we're going to pay in interest, because I've created all of our own pro formas. So whenever investor puts in money, I know that money is needed in that project and when it's needed. So we might have 3.1 million sitting aside for, 30, 60 days that I'm paying interest on before we deploy that capital. Does that make sense?
Yeah, that makes sense.
Yeah, because you don't know when you're going to close exactly. You just know that you need that money and you know when it's needed.
Yeah, which to me, I think is kind of a good segment into walk us through basically the first 24 to 48 hours after an investor, invests and capital hits the account. What actually happens, right after that period?
Oh, simple enough. So the day the money hits the account, the money is distributed into one of the actual LLC accounts. So it'll go from, let's say it's our fund, then it'll be dispersed out to one of the LLC accounts, which owns the piece of land or will be owning the piece of land that we're purchasing. So for example, Olive Boulevard was under contract with BluOnx. We don't ever close in BluOnx because you don't want the liability on BluOnx. So we closed in, I think it's called Olive Boulevard, the Overlook LLC, which is owned by BluOnx. So that money was dispersed over to that LLC, that bank account.
Awesome.
So if you invested 500,000, we needed an additional, let's say 400. I'd put 400 into that and then move the other 100 over to. I'm trying to think about where money's needed. I think the next one is Freeport. And then we got this other piece, I call it Kyle's piece, which, I know my name's Kylie, but this is a different person. So, but Kyle's piece over there in off of Orf Road over in Lake St. Louis, great deal, which those are going to be beautiful homes.
Cool. And then with Freeport, like I know a lot of those, I think all of the projects that we have coming up, if not most of them coming up in the Florida Panhandle, all of those have already been entitled. Just because the land bank that you're getting them from has already went through that process. Is that an accurate statement? Or
so yes and no. So it's already been entitled because Walton County, everything's pretty much entitled. The people that own that is St. Joe Paper Company. They are developers as well. So they entitle it, which it was already approved for 120 units. That's great. So we know we can build 120 townhomes. But what they approved it for was all one-car garages. You know how long it takes to sell 120 one-car garages? And not saying it's impossible. It just takes too long. So what we do is we go in there and re-entitle it, which if it's already approved, to make small revisions, moving it from 20-foot wide homes, which those are townhomes, over to 24 to 26 foot wide. It's pretty easy approvals. Everything's already approved. We're just making revisions, and we might lose some lots, which we actually didn't on this one because there was plenty of room to play with. Okay. But that process only takes about 90 days versus starting at ground zero and all the costs that's associated with that. But just remember, you do have a little bit of a premium to pay on that land because it already is entitled as well.
Very cool.
You know, are there any milestones that must be hit before a dollar really moves from, raised to deployed?
From raised to deployed, obviously it has to be approved. Like, it might go into a bank account, but that money is not deployed. So their money is just sitting in the Overlook LLC until that land is approved. So we won't disperse any money. I've done that before, and luckily it was on a one-off build that I did. Or well, it's two offs, I should say. There are two houses next to each other. I bought the land in August of that's many years ago, so I don't even remember the year. But anyway, I bought the land. It took me over 2 years to get all the entitlements done, and I had already purchased the land. So first and foremost, ever close on anything until it's entitled, because you never know what the city's going to come back with. I would never do that. I would never risk your money or my money. So more importantly, I would never risk your money, because I have to come back with that and make up for that. And if they won't allow us to build what we're trying to build there, we're basically just holding a piece of land that we probably won't be able to sell either for the money that we bought it for.
Yeah. And I think there's a lot of people that do it that way. I mean, they've got a pretty good idea that it is going to get entitled and fair, but there's so many. You could have some individual come out of the woodworks with some piece of paper.
Let me give you an example real quick. Okay.
Yeah.
Bates Road, one I was just talking about.
Yeah.
Okay. I was 99% sure, and I've been doing this for a long time. I was 99% sure this was approved.
Mhm.
We went to the Board of Aldermen for the last city council meeting, which had been tabled twice. So we had already been there like 4 or 5 times. I was like, all right, this is a done deal. No worries. And even the sellers were there and asked me, hey, do you think this can improve? I said, yeah, absolutely. I was wrong. I would have bet money on it. I would have bet $1,000 on it. But it was 3 votes yes, 3 votes no. And it came down to the mayor, which we actually had a city or meeting with personally, just us and one other lady. I had my team there with us, and we thought they were on the same page. They're the ones that told us what they wanted there. And comes down to it, we're about ready to close on it. We know we had about a week left to close, and they denied us. And I was like, that is crazy. So 3 votes yes, 3 votes no, but the mayor voted no. So he's the deciding factor. It was a no.
So did you guys you met with the mayor beforehand and were you were chummy with them, and like, he's like,
hey, saying that, but you have to be, like, and a lot of them are great people, but I don't like the deceptiveness that in that situation. So you never know, just because they said yes doesn't mean that's going to happen.
Well,
so
why does someone like that vote no? And I think this is also a people probably, because people never know about this. Like this is kind of new to me. Like, why would a mayor, this is kind of scandalous. Like, why do they vote no on something like this? Especially after meeting you and seeing what you're doing and doing all this, like, what gives?
Yeah, well, that was the first thing that we thought as well. So I actually had Steve, which Steve Valentine works for me now, and we'll have a part ownership in the St. Louis district for BluOnx. But I don't really know the exact reason. They said they just didn't love the town or the villas, and we're like, well, that's what you guys told us you wanted. You wanted R1 zoning, so we weren't changing zoning. You love the villas, and the neighboring neighborhood is villas.
Mm-hmm.
It was identical to what we were building. Identical. Yeah. And then they were complaining that, they wanted us to have access off of the service road. We couldn't get it. We reached out to MoDOT, so that wasn't possible. So they already knew all that stuff. So then they came back with that, they only wanted single family homes. Okay, we're going to present that to you. So now, here's the thing. Now, if you try to deny us now, you have a $500,000 to $1 million lawsuit on your way from us and the sellers. Promise. And it's not, I don't try to sue people, but when you've told us what you need to do and we're spending the money to make sure we conform to exactly what you're telling us to do, it's my money on the line. And if it is your money on the line, I'm definitely going to sue them. That's just crazy. You told us this is what you guys want, which I've never ran into this before. We have ran into issues, but not where they've said one thing and then switched it right at the last minute. That was just crazy. And I'm not sure for the whole reasoning why, but now we have it all recorded from about 12 people yesterday that were part of that meeting. So it's not like they can just back out of what they said.
Hopefully that works out.
It will. It'll be a good deal. I'm excited about that one still. So see where it goes.
Kind of on this topic, I mean, I'm just curious. So like, if in theory a deal kind of changes after capital is raised, what's your default reaction? How do you kind of handle some of those things?
Well, I guess give me a reason, because like I'm not saying something doesn't change, but it always changes right before you close. Like the Overlook, we made some revisions because, we didn't want to haul off, I forgot what it was, 213,000 cubic yards of dirt. That would have took us 6 months. And just that time delay, you got to understand you have $6 million plus out just on the land. And that time delay just would have killed us, honestly. We'd rather sell off the lots, reduce the lots by a few, and get moving. So for something to change afterward, it had to be pretty astronomical. Something that wasn't done properly, like the geo work, and then that always goes back to their insurance. They're insured in a lot of ways. So make sure you deal with good, legitimate companies that do have their insurance in place, because if there's something like, let's say, the engineer or the surveyor come, and they did their survey wrong, which it affected us by 5 lots or something like that. Yeah, but it all points back to the surveyor at that point. And that's where they would have an issue. I don't try to sue anybody, but they would have to make it correct, obviously.
Awesome. And have you ever chosen to not deploy capital, even though it was earmarked for a certain project?
not deploy it, but delayed it. Obviously, I've had that a few times. Delayed it because unless you know that your project is feasible and it's going to be done and it's going to be in the time frame that you're expecting, there's no reason to go ahead and purchase the land. I would say that's happened twice. It's not common, but as long as you work, again, it goes back. And I hate even saying this, but like the first person I picked out for GC work here when I moved back to Missouri stood us up. It was the 10th hour, and we were about ready to break ground. And he said he couldn't do the job, even though I had met with him probably a solid 8 to 12 times, and he just couldn't do the job. So I had to go out there and hustle, and I built some great relationships from that. That's how I actually became good friends with John Barrow over at Bear Construction. Great dude, very great dude.
So as far as like, I know that when you acquire a piece of land, the bank will finance, based on what I know, on average 65% of the purchase price of the land. Is the bank financing a portion of the job cost as well, or is it just the land purchase price?
So usually it's 65% LTV, loan to value, whatever the value would be. Now, with that being said, if it's a $20 million project and they're financing 65% of the LTV, they might also go off the LTC, loan to cost. Usually that still runs right around 85-86%. You're on average coming up with 15% of proceeds that are needed for horizontal, land, everything included. The reason why there's 3.1 on the overlook is because most of the money they always went up front on the land. And then they go pari passu, which pari passu, all it means is you're paying out a little percentage compared to what they're paying out on the horizontal construction to make it bounce back to that 85%.
Got it.
So if you put up 30 or 50%, now you got to get it back to the 85% because you put up 3.1 million on the land. The land was 6.2. To make it balance out, the whole project's 12. What is that? 12 million times 0.85. It's 10,200,000 that they're going to end up paying out. At that point, we're at 85%, but it has to balance back out through the horizontal construction aspect.
Got it.
So we don't have to put out much throughout that process, which is great because we put up the bulk right at the front.
And when it comes to paying the bank off, do you typically pay them a little bit upon the completion of each takedown? Does it vary? Like, do you try to pay them off as quickly as possible? Like, what's your move on that typically? Like, if there's a philosophy behind that?
I used to try to pay them off quick as possible. I don't do that anymore because the interest rates are pretty solid right now. I know people think they're high, but they're still actually pretty good for my industry. With interest rates where they're at, with our investors getting paid out the high rates we pay out, up to 18% plus, we're still making 30 to 40% gross profit on those. So I don't try to pay that off early, but on average, it's about 18 months. So a year and a half from the time we start selling lots till we pay them off. I just let it float because if rates were super high, I would probably switch that around. But right now, rates are good.
So I want to rewind for just a second because I think you just mentioned like after bank interest, after investor dividends. I mean, you're still profiting, like you're still netting how much on average after investor payouts and bank interest?
Disclose that a little bit differently. So
yeah.
If we're doing a lot takedown schedule,
Mm-hmm.
I think we average 36, 38%. I forgot what the number is, but we're doing really well. If it's a bulk buyout, my goal is only 20%, meaning that they come in and buy all the lots at one time. So if it's 50 lots, I'm only aiming for 20% because there's no risk at that point. I've already done all the horizontal construction. It took 4 to 6 months. Fish or whoever comes in and buys all the lots at one time, you make your 1, 2, 3, 5 million, whatever it is, and you move on.
And those are usually I would imagine that's on a much smaller project.
Yes and no. If you have the right price point, you can do it on the bigger projects as well. It just depends on what let's say we have that 500 units. I could sell that off in bulk, but I'd sell it off at a big discount because they got that holding cost associated with that. So does that make sense, or does it make sense for me to hold it and develop it out slowly and not have that holding cost?
I don't know if I'm following you completely. So what dictates, you're saying that the thing that dictates a 20% versus 35+% is whether or not they're buying the lots in bulk or a takedown schedule. I mean, let's just make it very simple for me to understand and anybody else who's having trouble grasping this. Let's say you have a 100 lot community. Okay. It seems to me like if you had to finish all 100 lots and then sell them all at once, why would that mean making less of a return? I'm not following, and I'm probably not even explaining that right.
No, you're explaining it right. So it's just more risk for the home builder. So they have to hold those 100 lots. That costs money. So if they want to buy them all in bulk, I'm going to give them a discount. The same thing when you buy anything. So you go buy a bunch of toilet paper, buy like 20 rolls of toilet paper, you get a certain price, but it depends where you're at, obviously. And if you go buy, 100, they'll give you a little bit of discount. Depends on where you're at. Obviously, some things are just flat rates, but that's anything in life. You can get a discount on anything if you buy it in bulk. So whenever I'm selling them lots in bulk, they have that holding cost. And with them holding those lots, they know that interest is going to accrue. And usually they just have a holding company they put it into, but you're looking at 14%. If I hold them, minimally 14%.
I see what you're saying. So they put up the money ahead of time of the completion of those 100 lots in that scenario, correct?
I think I froze for a minute.
Yeah. So the question was like, I get the toilet paper, buy in bulk, the whole Costco philosophy. Understand that completely. But what you're saying is in a takedown schedule, you're holding the lots, you're sitting on the lots. Therefore, like you're holding the risk.
Mm-hmm.
And you're selling them off in chunks versus when you have 100 lots, they're sitting on them, but you still have to build out those lots. So the question is, are they putting up money ahead of time to hold those 100 lots?
Well, if they're doing a bulk purchase, they're obviously buying them all at once. But let me explain that a little bit better too. So 100 lots, I'm not going to develop.
Yeah, I think that's the key differentiator here is 100 lots is always going to be a takedown for the most part, right?
Most
It's in
of the
that
time it will be.
like 60 and below, they're more likely to buy them all at once. That might fit that sweet spot.
No. So Pulte Homes just came in and bought 3,500 lots down in Walton County where we're building. But why would they do that? Because they got a great discount on them. They know they could hold them out through the next 3 to 5 years, and it makes sense for them to do that. So if they're in key locations, yeah, why not do it? I would do it.
Yeah,
I'm happy doing that, as a home builder. But you guys got to understand. So when I'm doing lot takedowns, though, and you'll ask this question in a sec, but I don't build out all 100 lots at one time. I'm only building out what are 15, 20, maybe 30 lots, and then I'm not keeping, especially for investors, because we're speaking about investor capital. I'm not utilizing their capital. It's put aside, but I'm not putting their money out right now. So their money's there if it's needed, and we're making our money off those first few lots. But anything that comes in, it's not usually much money that's needed at that point because we have money coming in from one of the builders. So we have a little bit of capital from investors that's still sitting there. If needed, we got the money coming in from the national home builders, which usually takes care of all of our second phase or second group of lots or whatever it is, at that point.
Yeah. So, and I think that kind of brings up another feature of our operation. Like you just said, a lot of times that investor capital sits aside. So what you're saying is we don't suck the life out of every dollar that comes in through the fund and just immediately deploy it. And there's nothing sitting aside into the fund. That's what you're saying.
No. Yeah, no, absolutely not. And like I told you, I've explained this to you guys, but just so everybody else on the same page, if we need, let's say, what was it for the overlook? It was 3.1 plus a little bit. I have $4 million that's in there that was sitting there. We still put a little bit extra in there just to make sure that the money's sitting in there in case what ifs. Yeah. You always have what ifs. Always have what ifs. That's built into the pro forma. Plus, we have a 3-year hold in our pro formas that in case, the market slowed. But with that being said, that money's just sitting there because you're always going to have what ifs. And that money needs to be dispersed from that particular bank account, not from BluOnx. It needs to come out of that bank account. And we know we have that money sitting aside for it.
Yeah. And I think that's one of the reasons why I think so many of these horror stories that we hear about, because, as much as I don't want to paint negative pictures, especially on this podcast, but it's important to consider why things go wrong and why people end up in these nightmarish situations. And I think the reason that they're so prevalent is because there's people out here that they have to raise X amount of dollars in order to get into the next phase or in order to acquire XYZ property.
Oh, yeah.
They have to do like a capital call, for example. They have to do this massive capital call and just get money from people in order to operate. In contrast, what you're saying is that the money's there if we need it, but it's not this big milkshake that just stays empty all the time.
No, because if you build, the way I built out the performas is our, 30 to 40% markup that we make on our side. It already has all that built in. It already has all the capital that I'm going to be holding from the investors built in there. So we already know what we're going to make, even holding that extra capital just sitting there for, the what ifs. I've never done a capital call, not saying it won't ever happen, but it shouldn't the way I built it out. So,
and if anybody wants to substantiate what we're saying, if they can just look at all the pro formas in our data room, maybe we can have our tech team drop that as in the description if people want to check it out and just kind of see, because you can see in our data room, at least for our potential investors, they can see what we're profiting as a company on all of these jobs after bank interest, after investor payouts. And they look fantastic. Fisher Homes pays well. And
yeah, and actually I had a great meeting with them yesterday, so they're they got a lot more they're trying to do with us, so we'll see where that goes. But we also have teams in place. You guys gotta remember, Daniel, Andrew, it's not just us. We got huge firms that work with us, all the accounting firms and all the attorneys and everybody to make sure that, I'm not going to say we're going to sit here and point fingers, but, we got the professionals in place that, hey, why did this not happen? Why is this messed up? Why are these numbers not right? It's not
Yeah.
just on us. Like if you're relying on your inner team, which can happen, we're not there yet, but our inner team is amazing. We've built out a solid team, but we got to have professionals that are outside of us, make sure that everything else is controlled as well.
I mean, and I think that's another benefit. And I talk about this on our webinar all the time. Like the way that you operate is kind of decentralizing those big moving pieces from you. Speaking of accounting, I mean, we use Accruity. They've got 40 years of experience. We use Accruity, correct? Yeah. Yeah. They handle all of that stuff. Like we keep track of it on a hard drive, obviously. But I mean, ultimately, like they're the professionals. I think that's another great feature of this company.
Yep. Yeah. I'm not here to sit there and promote them, but they, do a good job for us. So
I'm going to jump in here just from like an investor standpoint. How often do investors get updates on where their capital stands in the deployment cycle?
Well, I personally do monthly updates at the end of the month, every last Wednesday of the month. So I personally am on that. And I'm sure you guys have to relay some information as well. But we do monthly with quarterly distributions on what we're doing. It's a great setup. Investors love it. And a lot of them, continue to reinvest with us, which you guys know that's a big part of it. It's all about building trust with people. So,
and then as far as Florida goes, like I know going back to the conversation where, some of those are entitled and things like that, is that I would imagine that massively shortens, being that some of them are, even with having to adjust the plans and getting it re-entitled, I would imagine that massively compresses the timeline of those Florida projects and allows you to make more money in a shorter amount of time. Is that an accurate statement?
Yeah, absolutely. But also compresses the time. So when you're taking on those deals, that how fast you got to raise capital. So we do have 3 deals that are about ready to close. So all that money sitting aside for those deals, which is solid. We don't have any stress on that end, but we have numerous other deals in the pipeline that will be closing shortly thereafter. So again, back to raising the funds, those deals do close quick, but all of our investors' money is deployed into that bank account right off the bat. So we know it's sitting aside, we know it's there, we know it's ready whenever we're ready to close on that piece of land, which again, we're not going to close unless we have all approvals. That's all there is to it.